Chapter. We're looking at inventory costing methods though. And this textbook goes over three. There are actually more than three, but it goes over the three most popular ones, which is a good idea. I have some information on the board here. Beginning inventory, beginning inventory, we have 1,000 units. Whatever we sell, we have 1,000 of them, and we purchase these for $1 each. Okay, now we're gonna sell them for more than $1, right? We're not concerned about the sales price. We're looking at the cost of the inventory. So then we purchased 100 more. For whatever reason, we purchased 100 more. The price went up. It's $1.10 now. That's fine, but it's costing us more, so we may be raising our prices. But once again, we don't care about the sales price. Even though we're selling 300 right here, I don't give you the sales price. And the problem sometimes gives you the sales price, sometimes doesn't. Doesn't matter, because we're not concerned right now about the sale. What we're doing in this chapter is tracking the cost in inventory. So then we sell 300. I'm hoping you can right now see the problem. Which 300 did we sell? We've got 1,100 of them, because we have inventory of 1,000, and then here's $110. Which ones did we sell? Because we need to reduce inventory by the amount that got sold, okay? And that's where this chapter comes in. There's the Fifo Method, first in, first out. There's the Lifo Method, last in, first out. And there's the weighted average. Okay, there are the three methods. We're gonna go over these two in detail. And in this one here, I'm gonna explain how it's done, because there won't be time on the video to go over this in extensive detail, but it's pretty self-explanatory, pretty easy. It's just calculating a weighted average for each one. Okay, so we've got our purchase, and then our sale, and then our, I'm gonna put just EI, ending inventory. So we have 1,000 of them at $1, okay? Then we had a purchase, so we've got a purchase. I'm not gonna write that down, but you could say the purchase of 100 at 110. So now what we have in inventory is $1.10, I said that wrong, $1.10. So what we've got in inventory right now is 1,000 of these units at $1, and then 100 at $1.10. Now we're selling 300, okay? So here is the cost of sale, or cost of goods sold, sometimes we call it, okay? We sold 300. We'll go over the Fifo method first. We're using Fifo, first in, first out. Which ones were the first in? The dollar ones. So our cost of sale is gonna have 300 at $1. Okay, so that's expense. Cost of sale is the expense. I'm gonna say it again. The sales, we're gonna sell it for over $1, maybe $2, maybe $3. That's the sale portion. We're not concerned about that. We're just showing that this is reducing inventory by that amount, and we're putting that into expense. Okay, so that when we have a profit, we can show the sales less the cost of the item. So here's the cost of the item. So now what do we have left in ending inventory? Well, hopefully you can see we've got 700 at $1 and 100 at $1.10. So I like to write a little line here, because this was the inventory, and now this is the inventory. You can see all we did is we took some out of inventory, 300 out of inventory, out of our assets, and what did we do with it? We expensed it, okay? So this here is an expense. So let me just write down here really quickly. Let's say we sold these for $2 each, okay? Well, we had 300 of them, so our sales price was 600, right? And then our cost of sales is 300, because 300 times $1, $300. So then our profit, you can see, is $300. Okay? Hopefully that makes sense to you. Now what did we do? Well, we purchased 200 more. So let me put that down right here. I purchased 200 at $1.20. Okay? So this is what we have in inventory. And then we had a sale. We sold 900. So we sold all 700 of those, because this is first in, first out. This is FIFO. So we sold all of those. We sold 100 of those. And 100 of the $1.20, because we need 900 here, and here's the 900, 700, 800, and we need one more 100 here. So what do we have left? We have 100 left at $1.20. Okay, I think this is pretty easy stuff. You just got to kind of read it and make sure you understand the difference between FIFO, first in, first out, LIFO, last in, first out, and the weighted average. So this is the FIFO method. So now let's look at the LIFO method. Under LIFO, let's check that one off. Under LIFO, what's going to happen is we're going to sell 300 of them. Okay, so we have the 1,000, and then we purchased 100 more. LIFO, last in, first out. So we sold 100 of these $1.10 ones, and then those are all gone, so we've got to go up to there. So now we've got 200 of $1. So what do we have left? 800 at $1. Okay. Now, we purchased 200 more. There we go. We purchased 200 more. There we go. 200 at $1.20. Okay, so now we've got 1,000 in inventory. All right. And then we sell 900. Which 900 did we sell? Well, we sold all 200 at $1.20 because, like I keep saying, this is the last in, first out method. So we go this way, we go last in, first out. And so then what we have left is 700, because we sold 900, 700. So what we have left in inventory is 100 at $1. Okay? The textbook does a really good job of explaining why businesses use different methods. Well, if you use the LIFO method, you can see that our inventory is going to have a lower balance. Okay? Remember under FIFO, we had 100 left, but at $1.20. So if we have less in LIFO, if this is less, if our ending inventory is less, then our cost of sales is more. Okay, now follow me on this. Cost of sales would be higher if prices are going up. Prices have been increasing because it was $1, $1.10, $1.20. If you're selling those last ones first, you're selling the most expensive items. So your cost of sale is higher. If your cost of sale is higher, your profit, because cost of sales is an expense, your profit is lower. So if your profit's lower, you pay less taxes. So when prices are going up, under LIFO, you will pay less taxes. If prices are going up, under FIFO, you will pay more taxes. Okay? But your profit on your income statement will be better under FIFO because you'll have a higher profit because less expense. Okay, it's kind of confusing. I've said it. You need to read through the textbook and make sure you understand how that works because there are questions in your homework, and I'm sure on your quiz there'll be questions on that too. Okay, so this is how you do FIFO and LIFO. How do we do weighted average? Well, I'm not going to calculate the actual average because my numbers are off here, but what you do is you say, okay, I've got 1,000 at $1, 100 at $1.10, okay? So what happens is you've got 1,000, and then you've got 110, so you've got $1,110. You would divide that by your 1,100, and you get an average, okay? You'd get an average, and I just wrote on the other side of the board so you didn't see that, but you'd have $1,110, so you take the total cost of all of these, and then you divide it by the units. So that would then give you an average cost for each unit. So it's going to be somewhere between $1 and $1.10 will be your average. So then when you sell 300, you sell 300 of them at the average, and then you have 800 left at that average. Then you purchase 200 more. You didn't purchase them at the average cost, you purchased them at $1.20. So whenever you purchase more, you've got to calculate the new average. Okay? So let me repeat that. You always calculate the average after you purchase more, just before your next sale, because you sell them at the average cost. Okay? And it's just strictly a weighted average. You just take the cost of all of them that you have, and then you divide it by how many you have in inventory to get the average cost per unit. And then when you sell them, you're selling them at the cost of the average, that average cost. Okay, now that's not the price you're selling them at, that's the cost you're taking it out of inventory and putting into cost of sales. Okay, I know that's confusing, but that's how you do it, okay? So you're always calculating the average just before a sale.